Welcome to HardCap. HardCap, crypto and digital assets through an institutional lens. This week's hook. The SEC and CFTC just handed institutions a roadmap. 16 named assets, a 4-part taxonomy, and an end to the enforcement as policy era that kept serious capital on the sidelines. The question now isn't whether to build, it's how fast you can get compliant infrastructure in place before your competitors do. Lead story. The clarity trade. How the SEC-CFTC joint interpretation changes the institutional math. Last week, the SEC released a 68-page joint interpretation with the CFTC that does something years of congressional gridlock couldn't. It gives institutional participants a workable taxonomy for digital assets. The guidance names 16 crypto assets: Bitcoin, Ether, Solana, XRP, and 12 others, as digital commodities, placing them unambiguously outside securities registration requirements. The remaining universe gets sorted into 4 buckets: digital commodities, digital tools, stablecoins, and digital securities. Staking, mining, and airdrops are explicitly carved out of securities law. This matters more than the headlines suggest. The practical constraint on institutional deployment was never conviction. Surveys consistently showed allocators wanted exposure. It was the legal exposure of touching assets whose regulatory status was genuinely contested. A prime brokerage, a pension fund, or a tokenized fund manager can't build product around an asset if outside counsel won't sign off on basic custody and trading arrangements. The SEC's enforcement by ambiguity approach of the prior decade made that legal sign-off effectively impossible for anything outside Bitcoin and, eventually, Ether. That changes now. With named asset clarity and an explicit taxonomy, compliance and legal teams have the scaffolding they need to approve product development. The comparable precedent is the CFTC's 2015 order declaring Bitcoin a commodity. It didn't trigger immediate institutional adoption, but it removed a threshold barrier that allowed the infrastructure build-out, futures, cleared derivatives, custody, to begin in earnest. What followed over the next decade was the entire institutional on-ramp we have today. This interpretation is a second-order version of the same moment, but for a much broader asset set and at a time when the infrastructure is already largely in place. The accompanying MOU between the SEC and CFTC, establishing a joint harmonization initiative for coordinated oversight, joint examination, and unified enforcement, matters almost as much as the interpretation itself. Dually registered entities have operated under contradictory agency guidance for years, absorbing compliance costs that smaller competitors couldn't. A unified framework reduces arbitrage, lowers friction for large registered intermediaries, and signals that agencies are building for permanence rather than turf. For allocators, the immediate implication is product availability. Expect a wave of registered vehicles, structured products, separately managed accounts, tokenized funds that previously couldn't get to market. For dealmakers, watch the M&A pipeline in custody, prime brokerage, and exchange infrastructure. Compliance-cleared acquirers now have strategic cover to move. The wait for clarity trade just closed. The next phase is execution. 2 in 2. Kraken gets a Fed master account. Kraken Financial became the first digital asset bank to obtain a Federal Reserve master account, connecting directly to FedWire for atomic fiat crypto settlement without an intermediary bank. For institutional treasury operations, this removes the counterparty risk layer that has made cash management across fiat and digital assets operationally awkward, a structural problem now structurally solved. Delaware tables a stablecoin licensing regime. Delaware introduced SB 19 this week, establishing one of the first state-level regulatory frameworks for payment stablecoins. explicitly aligned with emerging federal standards under the Genius Act. It follows Hong Kong's issuance of its first stablecoin licenses earlier this month. The pattern of jurisdictions racing to establish compliant issuance infrastructure is accelerating, and the jurisdictional arbitrage window for early movers is narrowing. What I'm watching. Mark, July 18, 2026. That's the OCC's deadline for final rulemaking implementing the Genius Act's federal stablecoin licensing framework. The piece of the puzzle that turns stablecoins from a treasury curiosity into a regulated payment rail that major banks can actually issue against. The Delaware SB 19 introduction this week is a tell. Sophisticated actors are building state-level optionality ahead of federal finalization, which suggests the capital is ready and waiting for the rule, not the other way around. If the OCC hits its deadline, and the political pressure to do so is real, Q3 could see the first federally licensed stablecoin issuer. Watch who files first. Draft. For Luke's review before publication. That's Hardcap for this week. If someone forwarded this to you, subscribe at hardcapnewsletter.substack.com. New issues every Sunday. See you next week.